Hi, this is Peter with Quantum Edge AI. I'm going to show you how to create a chart of a delta neutral trading strategy so that you can see historical price of the spread and place your order in such a way that you're not going to get killed on the bid-ask spread. So let's do this. This is the trade. We're going to look at the analyze by calendar. We're going to take a look at the risk profile. We already have a position open at the 770. And what we can do here is take a look at the simulated. We want to be long this side, short this side. So we want to be short the front week contract. We want to be long the back week contract. So what's that mean? We want to add this position, copy, take it to the chart. You can control V, and then that will be the um, control V, and that will be the paste onto here. And then we want to take that. You want to remove the hotkey from there. And then we want to subtract the back month. So we have the 755 put here for the back week. And then we're going to look at the front week, the 755 put, and we're going to subtract this. Copy, minus sign, control V, and then there you go. You have the calendar for the 755 put. Now we can take a look at the because of the sim trading, we don't have the activity, but we can look at this and say, okay, well, where do we want to be for um, the entry? It's hovering at 475 now, but maybe we want to be around here in this area. The bid-ask spread is $4 to $4.95, and we want to get in between this area in a historical location where you're going to enter this position and you're not going to get killed on the bid-ask spread. So we have the bid-ask spread here at $4.49, $4.95, and maybe we want to place it somewhere in this range. As you can see, going historically, that we have this increasing movement, and this is due to what's called theta decay. This trade was constructed based upon Quantum Edge AI's forecasts. We want to be within this channel where the risk profile is in a place where the high forecast, you're within the high forecast on the upper threshold of the risk profile, and you're within the lower forecast of the threshold here. So if you look at the lower forecast threshold here, it says 3737, price be around here. And we can adjust this position to be less delta negative. And we can say, okay, well, where do we want this? How do we position this, optimize it such that it's within this channel? And we can do so by structuring it like this, 760, say okay, well 743, 743, 779, much further up here. So we have the potential for a positive surprise because it's an election. So What we want to do is be slightly delta positive, but we don't want to potentially get killed on the downside either. The idea of this trade is to take advantage of the of the option skew. If we look at the front week versus the back week, we're going to have around 7, around 12 and a quarter, and we want this to evaporate quickly versus this position. That's the goal of this trade. So we can go back actually and say, okay, well, you know what? If this position is really um, we want it to be the 760, not the 755, we can adjust this here, 760, 760, press enter, and we have the 760 spread. Um, yeah, this is nice to look at because you can get and make sure that so if the bid-ask spread, it looks as if it's over here, it's probably not. What you want to do is place it in this range where price typically has been oscillating. Okay. I think that's it for now. I just wanted to make sure that when you're entering a trade, an option spread, you're constantly looking at the bid-ask spread, and you're also looking at the historical pricing to make sure that you're not getting involved in a position that's anomalously increased or anomalously decreased. You want to get in this position in this zone. Here is a nice area too. You want to get in here. So below this movement upward. Thank you.